Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby. Good morning, everyone. This is Quincy Krosby. It is The Talking Point. It is Monday morning, June 26th, and we are in the last week as we get to the half-year mark for the markets. Now, here's what we're looking for. Number one, we started to see the markets begin to sell off last week, burning off some of that froth that, pushed this market higher dramatically. However, and I want to point this out, when you move into oversold territory, remember the market was overbought. Normally with overbought markets, you tend to hit a wall and you've got to sort of burn off some of that froth that built up as the buying fervor continued. Then the selling could hit, and then you can get into oversold territory. And we are moving in that direction in terms of being oversold. What that means is that at some point, a catalyst comes along, you burnt off a bit of that froth, the valuation on the market comes down, and then the catalyst typically helps bring buyers back in. So I want to go over a couple of things for the market to deal with this week. One is a tailwind that had been positioning, in which we saw pension fund managers, portfolio managers, and so on go into equities, right? Because they saw that there was momentum, the earnings were good, particularly in those large cap names, and we saw moving of money going in there. However, then you should see a rebalancing at the end of the quarter or at the half-year mark. And that is a potential from being a tailwind moving over to a headwind. By that, I mean you could have rebalancing by big pension funds, portfolio managers, institutional money managers that push them out of equities and more into the bond market because they have certain mandates that tell them what percentage they need in each area. So we are on the watch for that, right? It would take place this week. Now, the other thing I want to add here is there's uncertainty obviously coming from the events over the weekend in Russia. And I can't get into too much in this call, but what it does overall, it presents uncertainty. And as everyone knows, markets do not like uncertainty. In this case, the question really is, what actually happened? I mean, there are conspiracy theories that the whole thing with the Wagner Group was staged, but overall, the expectations are that Putin has been weakened. But if you're weakened and you're Putin and you're used to being completely in charge of the situation, what do you do now to maintain your status as, absolutely in control of the Russian state, not to mention absolutely in control of the war with Ukraine? That's what the market is looking at. Now, I have to say that over the course of the weekend, crude oil prices moved much higher on the concerns that maybe, just maybe, oil would be a victim, if you will, of the fighting. In other words, a cutback in oil production, especially on the Russian side. But nonetheless, that has recovered. Gold has not, flared up dramatically because gold would typically be a safe haven move. Same thing with U.S. Treasuries. So right now, the markets, I think, are much more focused on domestic issues, and that includes the Federal Reserve, right? Saying to a market that was already on the brink of again, easing a bit and basically saying, we see maybe the 2 more rate hikes. Powell mentioned it yet again. And perhaps now the market is saying, well, maybe he really, really does mean it. Well, he also has said, and this is important, that the Fed is not necessarily in a hurry to impose those rate hikes. They could take their time. He mentioned that, he used those words quite deliberately, because you've got 500 basis points already in the economy unfolding. And the lagged effect is about, 10 to 12 to 13 months before those rate hikes actually, the cumulative effect, actually work their way into the economy. So that left a bit of a question mark as to, is the Fed really going to stay higher for longer? Most likely the Fed doesn't even know the answer themselves because they don't know when they are going to reach that 2% level of inflation that equals price stability. He was adamant, however, that that is what the Fed is going to do. The question is that how much are they going to allow the cumulative effects of the previous rate hikes to do the job, or are they going to have to do the job themselves by raising rates 2 more times? Right now, I just want to point out, as I do this call on Monday morning, the Fed funds futures market is suggesting that there will be a rate hike on July 26th. The market is going to have to absorb that and then start thinking about what is after that. Nonetheless, Powell is in Portugal this week, where the European Central Bank holds their conference for central bankers. He's going to be in a discussion on financial stability. We'll see if he offers anything at all regarding his views on rate hikes and their effect on financial stability. Correct? That's what we're looking to see. And it's going to be interesting to see if he can offer any more information regarding how he sees financial stability in the United States, because that is an inherent mandate by the Fed. They have the employment labor market is a mandate from Congress, and so is price stability. But overall, for all central banks, it is to help maintain stability in financial markets. Then, on top of all of this, we have a series of data releases this week. And tomorrow, Tuesday, are durable goods. And the reason I'm highlighting this is that we know that durable goods sales have come down as folks use their money for quote-unquote experiences, for traveling, taking their families on vacations, going to concerts. I won't name names, but going to expensive concerts. And at the same time, within the durable goods report, there is a component, it's core durable goods. That is about capital expenditures, obviously, on the part of companies. We want to look at that and see whether or not corporate America has slowed down their spending on equipment, on software, etc., or are they continuing to spend? It'll give us an important clue as to how they view the future. Because if you think that, we're headed deep into a recession, most likely companies are going to hold back their spending. So that will give us a bit of a clue. Also, we're going to have consumer confidence and new home sales, not to mention the home price index tomorrow on Tuesday. On Thursday, we're going to have pending home sales. But on Friday is the big number. This is the number the market is waiting for. And this is the Federal Reserve Personal Consumption Expenditures Index, right? The price index. And this is a bit different from the Consumer Price Index, that CPI that we usually follow, right? But that is more of a, survey. However, the Personal Consumption Expenditure Index, which is the Fed's preferred view of inflation, and by the way, tends to run just a little bit cooler than the CPI. The information there comes from companies. So we're going to be following that. It's going to be very important, obviously, for a market that is so focused on the Fed's next move. This is going to be exactly what I think is going to help either dissuade the market that the Fed is running into 2 more rate hikes, or perhaps it will be maybe one and done. But this report is one that is highly watched. Also, on Friday, we'll have the final report on the University of Michigan's Consumer Sentiment Report. But again, embedded there is a view from the consumers on how do they view inflation over the next number of years, something that the Fed watches on how all of us, because remember, the U.S. consumer is responsible for 68% of the economy, of GDP. And if we start to see inflation climbing higher, and we expect it to continue, what happens is consumers start thinking along the lines of buy it today because tomorrow it's just going to be more expensive. And I should put an asterisk here, and that is the opposite is when we get into a deflationary mindset, it is, don't buy it today because it's just going to be cheaper tomorrow. So we're on the other side of that, right? And that's why we watch how do consumers look towards inflation. So far, by the way, just recently, consumers tend to be much more anchored in terms of inflation, but we will see if there's been any significant change. So overall, it is an important week for the market. Again, we are watching to see what happens in Russia. This is important because of the uncertainty that is embedded in any kind of situation, such as a potential coup, if you will, that was aborted. And the question is, where is the leader of the Wagner Group? Did he actually go to Belarus? Does anyone know where he is? And basically, too, is what is the vulnerability that is left in the Kremlin, and how does Putin come out and reassert his leadership? Well, market is watching for that. Now, also, I want to point out that we are going to have the beginning of the earnings season, and that will be on July 14th with the big banks. This is going to be extremely important. We say that almost every quarter, but obviously, as the market is focused on where we are headed in terms of cost cutting, where we are in terms of the global economy, rate hikes, how are companies dealing with this. It's important for markets that have moved up quite dramatically to hear from the companies themselves. So far, we did hear from FedEx, and I think everyone heard that they are, despite cost cutting, concerned about distribution, and that is inherent with demand, that they see demand coming down for movement of packages. Thank you very, very much. We will be back next week, and next week, of course, is the 4th of July, but we will still be coming back on Monday, and have a very good week. It'll be an important week. We'll see if the market, by the way, can move and get over this move towards their slightly oversold at this point, and have a rally that is more sustainable than just these short-term rallies that the market has been through over the last number of months. Thank you so very much.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.